Cost allocation is the general procedure for deciding how much things cost. This is very important for manufacturing firms, and you should read Chapter 6, which deals with the issue of cost allocation, before you watch this video. Chapter 7 deals with the issue of job costing, and Chapter 8 deals with process costing, and you need to understand the difference between job firms and process firms before we go on. Nobody tells a firm that it's going to be a job firm or a process firm. This is something that firms decide for themselves because of the nature of their production processes. A job firm is one that makes lots of different kinds of products that are significantly different from each other in terms of what they need from the manufacturing system. For example, a firm makes office furniture. It makes desks and bookcases and chairs. The process of making a desk is completely different from the process of making a chair. So a firm that makes office furniture is very likely to think of its work in terms of discrete jobs. That is, we're now making 100 units of desk model 1, 2, 3, 4, and we want to know how much it cost to make those particular desks. Now we're making a bunch of office chairs, and we want to know how much it costs to make those chairs. A firm like that would definitely choose job costing. By contrast, think of a firm that manufactures paint. It may make lots of different kinds of paint, but the process of making paint is always the same. It doesn't matter if the firm is making red paint or blue paint, whether the firm is making indoor paint or outdoor paint, whether the firm is making matte finished paint or semi-gloss or glossy paint. The process is the same. First, you put a bunch of chemicals into a vat and you mix them up, and then you pour them into cans, and then you put a lid on the can and a label on the can, and then you pack the cans up and ship them off to customers. Therefore, a firm that makes paint is going to think of its work in terms of processes, mixing, canning, and shipping, rather than in terms of jobs. This chapter deals with firms that use job costing. So the first thing we need to do is to think about some definitions. A job is a particular piece of work that a firm does. It could be a single unit of work, or it could be a number of units that are all the same. So the firm wants to know from the beginning of that job to the end of that job, how much did it cost? A job shop is simply a firm that chooses to use job costing because it produces discrete batches of particular products. And the way that they accumulate the cost for those products is on a job cost sheet. And I will show you one later in this chapter. Many firms use subsidiary ledgers. That is small accounts that keep track of something specific. a particular job, a particular customer, a particular supplier. Those subsidiary ledger accounts play into a control account in the general ledger. So, for example, a firm that has many customers who buy products on account would have a separate account receivable for each customer, and the total of those accounts receivable would equal the accounts receivable that's shown in the general ledger, and that would be called the control account for the total of all of the subsidiary accounts. Similarly, a firm that uses job costing may be working on a number of different jobs at the same time. That firm would need a subsidiary ledger account to track the specific costs that go into each job, because each job is different. However, they would also need to summarize all of the balances in the subsidiary accounts into a control account in the general ledger. So let's take a look at how that works. There are 3 phases in a job cost system: acquisition, measurement, and assignment. In the acquisition phase, the firm acquires all of its production costs, materials, labor, and overhead. In the measurement phase, the firm keeps track of what it used those costs for. And in the assignment phase, it sends those costs first to finished goods, and then when those goods are sold, their costs are transferred to cost of goods sold and matched against sales revenue. So, all production starts with materials. At the beginning of each period, the firm has a beginning balance in its materials control account. That represents materials that the firm had purchased in the past and hadn't used yet, so they're waiting to be used. In addition, in the current period, the firm may buy more materials. Altogether, the old materials and the new materials represent all the materials that the firm has. Now the question is, what happens to those materials? Well, some of those materials are used directly in the products that the firm makes. The cost of those materials is going to be transferred to the work in process account. However, the firm may also have materials that it uses indirectly: cleaning supplies, repair parts, light bulbs, paper towels. Those things don't go directly into the products. Instead, they become part of overhead. In addition, the firm may also have some materials that actually do become part of their products, but not in a way that the firm cares to measure. For example, a firm that manufactures furniture may glue laminate to an underlying composition board. In that case, they want to measure the amount of laminate that they use and the cost of that laminate very carefully. And they want to measure the amount of the underlying board and the cost of that board very carefully. But they are unlikely to bother measuring and costing the glue. Therefore, glue would probably also be treated as an indirect material. Similarly, a firm acquires workers' time and their effort and the cost of that time and effort through payroll. Every day that workers come to work, they punch in on a time card, and at the end of the payroll period, the firm is going to compute how much they owe the workers, and they're going to pay them. The work can be either direct, that is, these particular workers are working on this particular job right now, or some of their time may be used indirectly. For example, a worker expects to be paid for all of the hours that they work, but they don't spend all of their time actually working on particular jobs. They have lunch breaks, they have training seminars, they have to wait around while the work area is cleaned up or new raw materials are delivered. The portion of the time when they are not directly working on a job is treated as indirect labor, and it becomes part of overhead. Now let's talk a little bit more about the overhead account. We already said that it includes indirect materials and indirect labor, but it may also include other overhead items. Any cost that is related to the factory or the manufacturing process, but is not direct materials or direct labor, is considered overhead. That might include rent, depreciation, insurance, supervision, or any other costs that are involved in production but aren't direct materials or direct labor. All of these costs on the debit side of manufacturing overhead control are recorded at their actual cost, whatever they cost the firm. So if we look at the 3 T accounts in the acquisition phase, we see that they all behave as assets. That is, they increase on the debit side when we acquire the 3 factors of production: materials, labor, and overhead. And they decrease on the credit side when we use those factors of production. We already saw that direct materials go into work in process as they're used, and direct labor goes into work in process as it's used. But overhead can't be traced. There is no way to know for sure how much overhead is consumed by the various jobs that we do. So instead, we are going to figure out a way to apply or allocate the overhead to the work that we are doing. And I will show you several ways to do that later. Meanwhile, in our work in process, we've added materials, we've added labor, we've added overhead. Eventually, some of our jobs get finished. And when they do, they leave the production area and go to the finished goods warehouse. At the same time, the balance in our work in process account goes down, and the balance in finished goods goes up. Eventually, the goods are sold, and when they are, we transfer their costs out of finished goods and send it to cost of goods sold. That recognizes that we no longer have the items and that it cost us something to earn sales revenue. So we also recognize that we've had a sale, we've earned that revenue, and either we get cash now or we get cash later from our customer. The difference between cost of goods sold, what it cost us to provide the product, and the sales revenue that we get from our customer is our gross profit. So now let's take a look at an example of a firm that uses job costing. Tightwire manufactures custom steel frames. Each steel frame or each set of steel frames is different, and because of that, the firm uses job costing. At the beginning of March, the firm had a balance of $30,000 in materials control. That means they had bought materials before March 1st and they hadn't used it up yet. They also have a $41,000 balance in their work in process control for job 1503. That means they must have started that job before March 1st, but haven't finished it yet. In addition, they have job 1502 that's in finished goods control. That means that they finished that job before March 1st, but they haven't sold it yet. Now let's see what happens to the firm during the period. In March, the firm bought $135,000 of materials on account. We recognize that by debiting, increasing materials control for $135,000 and crediting accounts payable. Later on, when the bill is due, we will pay that account. In March, the firm used some of that material. Now, somebody has to tell us how much material they used and what they used it for. We're told that $12,000 of material was used for job 1503, and we started 2 new jobs. Job 1504 got $102,000 worth of materials, and job 1505 got $15,000 of materials. So that means we're going to debit, increase our work in process control account by the total amount of materials that we added during the period. And we're going to credit our materials control, showing that those materials got used. So let's take a look at how this affects our T accounts. At the beginning of the period, the firm had $30,000 of materials in its inventory. And during the period, the firm bought another $35,000 worth of materials, and they'll pay their supplier for it. During the period, the firm used $129,000 worth of materials. That means we have to reduce the materials control account and increase the work in process account. So now, in work in process, we had a beginning balance of $41,000. That was the job that had been started before March 1st. And now, in the month of March, we're adding new materials. But in order to understand how much each job costs, we need to use our subsidiary ledger. Here, we've already recorded the $41,000 of materials, labor, and overhead that Job 1503 had received previously. And we started Job 1504 and 1505. So we need to recognize the portion of the materials that was used by each job. Remember, job order costing is based on the idea that each job is different, so we need to track that particular job's costs individually. So now, during the period, our workers worked on these jobs. For job 1503, we recorded $16,000 worth of direct labor, $71,000 for job 1504, and $11,000 for job 1505. So we need to recognize that. The journal entry would be a debit increase to work in process control for a total of $98,000 and a credit to payroll. How is this going to affect our ledger accounts? Well, means we're going to owe our workers $98,000 for the time that they spent directly working on these jobs, and it means that the value of our work in process goes up by $98,000, the value of their work. But in the subsidiary ledger, we need to record how much of that $98,000 was consumed by each job, like this. In the next section, we'll talk about how to handle overhead.